This is the morning brief from the Economic Times.
For market experts, watchers, and many investors across the world, Aswath Damodaran needs no introduction. Popularly known as the Dean of Valuation, the Professor of Corporate Finance and Valuation at the Stern School of Business at New York University is one of the finest minds and candid voices on capital markets and the art of investing. Professor Damodaran spoke to us as the world and its markets reeled under the impact of the horrific Russia-Ukraine war. In the Indian markets, somewhat removed from the turmoil, other interesting stories have been happening. Blockbuster IPOs of tech startups, followed by a free fall of their stocks and billions of dollars of market valuation and investor money wiped out. Stocks of Zomato and Paytm, two IPOs which Professor Damodaran wrote about and valued, have lost 38% and 50% of their value respectively since listing. Meanwhile, on the cards is the mega IPO of Life Insurance Corporation, expected to form the country's largest listed entity. On the other hand, inflation continues to spook the world and India. Central banks globally are trying to come up with ways to control it without disturbing the health of the economies. After all, they're just out of the ravages of the COVID-19 pandemic and probably headed for another plunge if the war doesn't stop. In this episode, Professor Damodaran speaks on all these issues in his trademark style. No words minced, no punches pulled. It's Thursday, the 3rd of March. I'm your host, Anirban Chowdhury, and you're listening to Truth Bombs from Aswath Damodaran on the Morning Brief. Professor Damodaran, good morning, and thank you so much for being part of the Morning Brief.
You're welcome. I'm glad to be on.
Professor, let's talk about the most interesting story of Indian markets first. The highly valued tech startups. A number of them, Paytm, Zomato, Nykaa, which had blockbuster IPOs, they've lost tremendous market value in the last few months. Do you think it affects investor appetite for the upcoming tech IPOs? I mean, will the investors and should they be wiser now while they invest in loss-making tech startups? And does it spoil the party for the others in the pipeline, so to speak?
I mean, IPOs through their history have always gone through booms and busts. We need to remember history when we look at IPOs. This isn't new. This is as old as time. You could go back to 2001. You could go back to 1991. You could go back to the 80s. Now, if you think about the IPO game, it's a pricing game. It's not a value game. The people who play IPOs are not investors. They're traders. And I think we need to be clearer about who we're protecting here. Let's stop acting as if these are poor investors who are being taken to the cleaners. These are traders. They were driven by greed to put their money into these IPOs. And guess what? What comes easy goes easy. So this is, I think, something that has always been true. And if the momentum has shifted, it's not that the IPOs did something to ruin the momentum. Markets change moods. And the mood has shifted in markets now against high growth companies, not just IPOs. It's across the board. If you look at tech companies, there's a markdown happening. And before we think of this as something momentous, we also have to remember the run that happened before the markdown happened. So I think it is true, momentum has shifted, but momentum could shift again. In 2019, before COVID, you had momentum shift against IPOs, but it came back again. Risk capital comes into the game, it leaves the game. It's natural. It's part of markets. So I wouldn't lose too much time overanalyzing it. It is what it is.
Are there some upcoming IPOs that excite you? What do we see the next blog post on?
I think that I'm a dabbler. I go to whatever interests me. The reason I picked on Zomato and Paytm is not because I'm fascinated with Indian IPOs or US IPOs or any sector. It's because they were telling a macro story. I mean, let's face it, the biggest selling point for both Zomato and Paytm had little to do with the companies themselves. They were selling India as a country. I mean, the advantage of having 1 billion people is everything you do becomes magnified because the potential market is so big. So I could see the appeal to investors saying, look, Chinese tech companies are having a hard time. We need to find tech companies with huge potential markets. US tech companies have hit a wall because the US market and the European markets have become pretty saturated. So guess where people look? They looked at Indian tech. So I will leave the door open to whatever interests me. And if that next interest is in IPOs in India, that's where I'll go. But my guess is you're going to see something else pop up that's interesting. Maybe it's commodity companies, because I wouldn't be surprised if inflation becomes the bogeyman that we think it is, that's where the next action will be, not in young tech companies, but in old commodity companies.
Oh, that's interesting. Are there any companies that intrigue you in that segment?
Think anti-ESG and go there. And you're going to see the companies that ESG advocates tell you are the evil companies, or the companies that are going to become most interesting because you're going to be faced with a choice, which is a healthy choice. Do you want to be good and make less money, or do you want to be okay investing in these companies that people call bad companies to make more money? We're going to see ESG being tested with money. And we're going to find a lot of people who talk the ESG game are not willing to walk the game, which is give up returns to be good.
Okay. Let me now bring you to an IPO that has made many of these new companies defer theirs because it will suck a huge amount of liquidity out of the system. I'm talking about the mega listing by LIC. Now, the street is really divided on this upcoming share issue, right? Many call it the listing and investment of a lifetime, pun unintended. And many say that with government still retaining 95%, its finances, etc., and even the investment portfolio will continue to be opaque and muddled. What's your take on the LIC IPO?
Now, if you step back and think about any insurance company, there are two drivers of value. One is on the insurance side of the business. What are your premiums? What are your payouts? Good insurance companies generate premiums that exceed their payouts. The half of an insurance business is how you take those premiums you collect and invest them. I'll give you an example of an incredibly successful insurance company. Most people don't think of it as an insurance company, but it's Berkshire Hathaway. You got Geico as the insurance company, a very well-run insurance company, an extraordinarily efficient company delivering premiums that exceed the payouts.
Right.
But for 40 years, Berkshire Hathaway has had the most successful portfolio manager in history, managing the other half of the equation. So guess how it's paid out? Berkshire Hathaway historically has traded at a premium multiple of book value. So one way to think about what investors think about an insurance company is what multiple of book value you're willing to pay. A typical insurance company trades at 1.5 to 2 times book value. Berkshire Hathaway used to trade at 4 times book value. But that has faded. And there's a simple reason. Mortality is catching up. But Warren Buffett, no matter what you think about his greatness, is 90 years old. He hasn't been picking stocks at Berkshire Hathaway now for a decade. But when he dies, and he will, and I'm not making any predictions here, but it's everybody is born and everybody dies, there's going to be a reckoning. And I think with LIC, that's what you got to think about. How good is it as an insurance company? Historically, its benefits came from the fact that it was a monopoly insurance company. I remember a time where the only place where you went to get insurance was LIC.
That's right.
That insurance business in India is going to get more competitive. On the other side of the equation is what troubles me about LIC. If you think about Berkshire Hathaway getting a premium because you're taking this premium money and investing in good companies, LIC has actually been forced by the government to be the investor of last resort. An investor in companies where nobody else will invest, which is fine if you're a government-owned company. But if I'm investing in an LIC and the government continues to run the company and use its capital to invest in companies that nobody else will invest in at prices they should not be paying, then I'm going to attach a discount to the company. So this is not a question of whether you're investing in a good company or a bad company. You got to be realistic. With LIC, you're getting a big insurance company, a company that had the benefits of being a monopoly and therefore is a huge company. But at the same time, you're getting a company that's going to be handicapped in how it invests its money because of the fact that the government will stay as an influencer in where it invests its money.
Right.
So if I'm investing in LIC, I need to get some sense of what the government plans to do on the investment side before I decide to put a pricing on the company.
All right. That's really well put. Talking about, liquidity, which I started my question on, and coming back to tech startups, they have now explored this full cycle of liquidity sources, right? Starting from seed capital to venture capital and then private equity investment, and now, retail investors, which isn't going very well for some of them. Where do you think the next round of liquidity will come from?
I think of it less as liquidity and more as risk capital. Risk capital is money that people are willing to invest in the riskiest parts of the market. High yield bonds, risky stocks, young startups. And during COVID, one of the things I noticed, which kind of set this crisis apart from all previous crises, was how resilient risk capital was. Venture capitalists stayed in the game. Investments in the riskiest companies stayed in the game. And that's one reason why we came back so strongly from that COVID collapse between February and March of 2020. Risk capital, though, is fickle. I mean, it can come and go. And I think it's less an issue of liquidity as what's going to happen to risk capital this year. And this is a global question. It's not just about Indian startups. It's not about tech companies. It's about risk capital in general. I think risk capital has been in the market for a long time, but there's always one big shock that can cause it to go back undercover. And that's basically the question we have to ask. To me, my biggest concern for this year across the globe is inflation. Because governments for a couple of years around the world have been spending like drunk sailors. Historically, when you spend money like drunk sailors, and I'm probably insulting drunk sailors by likening governments to them, it catches up with you. And inflation has been deadly for risk capital over history. Go back and look at the 1970s. Basically, if you're risk capital, inflation drives you underground. And I would say this about not just risky assets, but about these investment classes like Bitcoin and NFT that have benefited from risk capital staying in the game. We're all globally connected. What's going to happen to Indian tech companies and Indian IPOs is very much connected, not just to what will happen to US tech companies and US IPOs, but what's going to happen to Bitcoin and Ethereum and NFTs as we go through this cycle.
Right.
So it's going to be fascinating to watch because globally, risk capital seems to be moving across the globe at about the same cycles. It's not as if India can be separated from the rest of the world.
Right. Since you talk about the US, let me talk about this phenomenon that had gained some sort of popularity last year, but seems to be dying down. I'm talking about SPACs, which for our listener is a special purpose acquisition company formed for the sole purpose of an IPO. So they were getting pretty popular. We had Renew Energy. We also had Freshworks. Do you think that this run will be stalled?
This has everything to do with what I was talking about, which is risk capital. When people are willing to kind of invest in risky things, they often let their guard down. But SPACs are unique because they reflect the times we live in. The way I think about it is if you're an investor and you're investing in an IPO, you got to do your homework. You got to make your own assessments. You know what? We live in a world where we want to outsource our decisions. And guess who we want to outsource them to? Celebrities. If you look at SPACs and how they're constructed, it's very interesting. I mean, there are SPACs in the US that have Shaquille O'Neal and, celebrity football players in them. You're saying, what's that got to do with investing? Because SPACs are about people with big Twitter followings that you can use to pump up a stock. And guess what? At some point in time, reality kicks in saying, you know what, Shaquille O'Neal doesn't know much about investing. Why the heck am I buying a stock because he claims it's a good idea?
Right.
So SPACs were always a bad idea that got too big. And if you think about the fundamental flaw with SPACs, it's the fact that the promoters get 20%. I mean, investing is a tough game to win in the first place. But if you give up 20% of your capital, it becomes an impossible game to win in the long term. So in the long term, this was always going to catch up with SPACs, so it doesn't surprise me. The Fed might like to claim credit for this, but I don't think the Fed has much to do with the reckoning that is coming for SPACs.
Now that you talk about the Fed, I'd like to draw the listener and you to a discussion about central banks in general. Like in India, not just tech companies, there are instances of several companies being overvalued. Now, you've said that the central bank is as responsible as the investor for this mad dance. I mean, you've called it the Wizard of Oz because of its perceived rather than real power. You've actually called central banks certifiably insane, in one of your interviews, because they keep doing the same things over and over again to solve new and dynamic problems. In this overvaluation game, and what you said about risk capital, what can central banks do to step in and stop this? Can they do anything?
In fact, that's exactly the problem, is the hubris of central bankers thinking they can step in and stop something. I mean, I think in the last 20 years, central bankers seem to have taken on the role that fiscal policy planners did. They've taken on the role of, we'll keep the economy going, we'll protect risk takers from losing too much money. And when you do this long enough, you encourage really bad behavior. Now, I talked about the kind of explosion of risk capital. One reason that you're cautious about risk capital is you're worried about the downside, right? That's partly what makes you prudent in how you take risks. What if I step in and say, there is no downside. Every time stocks go down, they always go back up. Every time there's a cut in prices, you recover in the next 6 months. I'm encouraging you to take risks you should not be taking. So I think central banks need to go back to their original role, which is, essentially, if you think about a central banker's core job, it's to preserve the health of the currency, is to prevent your currency from getting debased. It's not to protect the economy from going into a severe recession. It can fine-tune things to kind of manage the economy, but it shouldn't be thinking of itself as the prime driver of the economy. So when I described central bankers as insane, what I was talking about was this phenomenon. And post-2008, you've seen this phenomenon of central bankers step in and acting as saviors for economies. And you know what? Investors have gone along. I think the foremost dangerous words I've heard from investors is the Fed did it. Because then you're not taking responsibility for your own actions. It's all the Fed's doing. And you're starting to hear the same thing right now, right? The Fed is going to raise interest rates. Come on. The only rate the Fed changes is the Fed funds rate. My biggest worry for the next year is not what the Fed's going to do to interest rates or what the global economy will do. It's how inflation is going to behave over the coming year.
Right.
If inflation stays high in the US and Europe, as I think it will, then I think you're going to have a reckoning. Interest rates can't stay low if inflation stays high, no matter what the Fed says or does. I think that is going to be the test for markets. If you're looking for something that's going to make risk capital go into chill, right, it's going to be the return of inflation. So let's get focused on the real issues in the economy and let's stop using central bankers as kind of a shield against talking about the things that really matter.
Professor, let me now bring you back to the overvalued tech startups in India and talk to you about systemic changes, right? For example, the capital markets regulator in India has recently said that it plans to ask new age tech companies to justify the pricing of shares for their initial public offerings. Do you think that'll help? And, what more needs to be done?
Now, I think investors need to take responsibility. Why is it the central bankers or regulators' responsibility to make sure you don't pay too much? Come on. Paytm and Zomato, there was nothing in their statements that said pay 200 rupees per share. The reason we have overpriced stocks is not because regulators are not doing their job. It's not because companies are pulling off a con game. It's because people are greedy. It's not the regulator's job to be your nanny, to be a babysitter when you take risks.
But surely the companies themselves need to be more accountable. For example, let me quote a blog post of yours where this is what you said about Paytm. It resembles an adolescent with attention deficit issues in its scattershot approach to growth and absence of attention to business details. And if you are the investor, you have to hope that going public will cause it to grow up quickly. So, and this is true of a lot of its peers, right? The difference of the scattershot approach, I'd say, is just in degree. Isn't there a lot that the tech companies themselves need to do to fix before they even come to markets in terms of accountability and governance?
That's a good question. The question, were investors aware of the fact that Paytm was just going for users? I mean, all I had to do, actually, the day I decided to value Paytm, I put the Paytm app on my phone. And all I've been getting since, and I've kept the notifications on, is free services that they offer that I hope I will try. There's no secret that Paytm has gone after users. This is not something they were hiding. In fact, my problem with Paytm is that they were catering so much to traders, looking for, hey, how many users do you have, that they were playing the wrong game.
Right.
My advice to Paytm is you got to ignore the market and actually build a business. Now, this has nothing to do with what people chose to price the company at. So if I were advising these companies, I would be advising them on building a business. But guess what? If people keep rewarding companies for having more users, having more subscribers, they're going to play that game because that's what you're rewarding them for. Again, we're blaming companies for what traders have been rewarding these companies for. It's like blaming Netflix for going after increasing the subscriber base.
Right.
For 15 years, Netflix's stock price has been driven up every time their subscribers go up. We get exactly the companies we deserve. And here are the companies we deserve. We deserve companies that go after users and subscribers because for 10 years, 15 years, those are the companies whose stock prices have been pushing up. Ultimately, the responsibility belongs to us as investors and traders, and each of us has a choice. If you want to play the trading game, you can go after the Paytms and Zomatos and push them to drive out their users. If you're an investor, you can choose to stay out of the game until you think the price is right. And I think that's a decision each of us has to make individually rather than hoping regulators make it for us or managers make it for us.
But then coming to your core subject of expertise, which is valuation, and in your book, Narrative and Numbers, you call valuation a bridge between numbers and the stories behind them. But, what's happening now is that the stories aren't believable. They aren't dependable. They don't answer your basic questions that you cite of the possible, plausible, and probable. What happens to valuation then? Does it get affected?
I think the problem is not that the stories have lost their basis, that they're implausible. It's that we've outsourced the storytelling. What I mean by that is a lot of people are trading in these stocks, investing in these stocks based on management story, based on Goldman Sachs story for the company. So some people are telling stories that I think are fairy tales. In fact, the biggest fairy tales I hear are macro stories. Macro stories are not grounded in reality. What I mean by a macro story is when I ask you, why should I buy Paytm? You tell me how big India is as a country. That's not a story about a company valuation. It's part of a story. It's the beginning of a story, but it's not the end of the story. So I think what we need are more complete stories that are not just macro stories. And let's not just blame Indian investors. People have been doing this around the world. In fact, for a decade, people have invested in Chinese companies based on a macro story. China is a big market, and we're going to make a lot of money because it's a big market. That's incredibly lazy and sloppy.
Right.
So I think not only do we need to test these stories, we need to make them complete business stories, not just stories about countries and markets being big, because then we risk overpaying for a whole bunch of companies.
So finally, on the horrific Russia-Ukraine conflict, which is now actually a full-blown war, how do you think that'll affect markets and the risk capital cycle?
I think that this conflict has the potential to create incredible damage, partly because of the parties involved. I mean, this isn't a fight between two small countries. We're not worried about spillover effects. This could very quickly spill over into something much more dangerous, potentially even catastrophic. And that scares markets. The probability of that happening might still be low, but you got to worry about it. But I think it points to a two bigger lessons. The first is you don't want to react in the moment. Because if you take what's happening right now, you abandon everything that you've learned so far, you risk doing things you shouldn't be doing. I've told people that two things happen in a crisis. First is you lose your mind because you look at what's happening. Then you lose your fundamentals because you lose everything you brought to the table. My advice is when you have a crisis like this, go back to basics. Ask yourself, how is this going to play out on an expected basis? And where is it going to show up? The reality is it might show up as an economic recession that it puts the world into. Oil prices being greater than $100 a barrel could add to that. It could be the potential for lives lost and terrorism and war that might affect much of Europe, at least in the near term, and potentially the world. That could be even more catastrophic. But whenever I'm in a crisis, my tendency is to take a step back and look at the bigger picture. What does it mean? I think it's a reminder, and I think this is a healthy reminder. We talked about how risk capital has been so easy to get for the last few years, perhaps even the last decade. Maybe it's a reminder to risk capital that there are real risks out there, that not everything that goes down comes back up. And that might be a call for risk capital to pull back from the game. So even after this crisis is over, maybe risk capital will not be as willing to enter the game. So I will continue to watch and wait, but I think you're seeing it play out in markets in terms of what you're seeing to stock prices. But the longer term effects, we still have to wait and see.
So that was Professor Damodaran, candid as ever, speaking his mind on issues ranging from the greed of investors to the hubris of central banks. While the cycle of markets and risk capital will go on and stocks continue to rise and fall, what worries the professor are not so much fudged numbers as incomplete stories behind them, not so much overvaluation as inflation. And he, like the rest of us, is as worried about the current losses from war as its catastrophic after effects for a long time to come. That's it for today. You were listening to Truth Bombs from Aswath Damodaran on The Morning Brief. This episode was produced by my colleague Nehal Chaliawala from The Economic Times and Varun Kapahi from Awaz. Executive producer Arijit Barman. Do write to us at themorningbrief@timesgroup.com. The Morning Brief airs every Tuesday, Thursday, and Friday. Thank you and have a good day. All clips used in this episode belong to their respective owners. Credits are given in the description below.